So earlier I showed you this video where we had products and it had this inventory activity for the month, and then it uses FIFO to record its cost of its goods sold during the period. So we went through all that, and then just to give you the ideas, you have beginning inventory, you have your purchases. So if you look here, you have your beginning inventory plus your purchases. By the way, remember when you buy inventory, all costs to get your inventory in place and ready to sell, which would include the shipping costs, minus any discounts or any returns that you may have had. So your beginning inventory plus your purchases, that's all the goods you had available to sell. We needed to know that for our average cost, right? Well, those dollars can either be still here as inventory, or they've gone out the door as cost of goods sold. So at the end of an accounting period, the company should, or at the end of a year at least, should count its inventory. So they may be had, according to the records, 10, but maybe they find out that there's only 9. Maybe one got stolen. So basically what you would do in that case is you have all your goods available to sell, you count your inventory and get that amount, and then plug your cost of goods sold. So if you're using what's called a perpetual inventory system, what you would basically be doing is adjusting this number. So in this example, it would have to be 99, and then our expense would have to be 11 more, so it would have to be 163 in total. So in other words, my expense on my income statement would be a total of 163, having sold 15 but lost 1. Now there's many companies that don't have the sophistication and instead will use this, what they refer to as a periodic inventory system, and that is basically where you record your sales, but you don't make this entry. You leave that alone. And at the end of an accounting period, before you give out financials, management will take that beginning inventory plus their purchase, take this amount, go out and count and figure out what their ending inventory is, and subtract that from all the goods available to sell to get this amount here, and it'll do one big entry for the whole accounting period. So perpetual is the better method. It's more up to date, though no matter what method you use, perpetual or periodic, you still have to do an inventory count to make sure that there isn't any theft or obsolescence. So that's the difference between periodic and perpetual, and what companies do in terms of adjusting their records for any theft or any inventory shrinkage.